Happy New Year, everyone. Welcome to 2026. We made it. And what a year 2025 turned out to be. The greatest year for precious metals in over 4 decades. Gold finished at $4,549 per ounce. Silver touched $83.62. These are numbers that would have been considered fantasy just 12 months ago. But before you pop the champagne and celebrate the victory, I need to tell you something that the mainstream analysts are saying right now that could shake your conviction to the core. And then I am going to show you why they are fundamentally wrong. Because the same people who told you not to buy silver at $30 are now telling you to sell at $70. And if you listen to them again, you will miss the greatest wealth transfer of our lifetimes. Let me start with what the bears are saying. One of the most widely followed technical analysts just published his silver outlook for the new year. His exact words were, "My prediction is that this ends up in tears." He went on to say that silver is unsustainable at these levels and that you are starting to see the wobble. He warned that markets this volatile typically favor the downside because eventually nobody wants to play the game anymore. He advised traders to take profits and reduce position sizes. He even suggested that we probably need to give back some of these gains. This is the narrative being pushed across financial media right now. And I want you to understand exactly why this perspective exists and why it is dangerously incomplete. The analyst is correct about one thing. Volatility is extreme. We just witnessed silver drop over 11% in a single session on December 29th. Gold plummeted $250 in a single day. The CME Group raised margin requirements twice in 60 days. Advisory number 25-393 on December 20th increased initial margins on silver futures to $25,000 per contract. That is a 14% hike designed specifically to cool the market down. And yes, on New Year's Eve, silver was trading down 8.5% before the American pits even opened. Traders were rushing to close positions and get clean sheets heading into the new year. The price action has been nerve-wracking. Nobody disputes this. But here is what the bears consistently fail to mention. The fundamentals have never been stronger. Let me give you the context that transforms this analysis from fear to opportunity. Gold just posted its largest annual gain since 1979. Silver just posted its best year ever recorded. This is not a speculative bubble driven by retail mania. This is a structural repricing driven by forces that cannot be reversed with a margin hike. The primary driver is central bank de-dollarization. In 2025, official sector gold buying hit its 3rd consecutive record year. India, China, Turkey, and dozens of other nations have been systematically converting their dollar reserves into hard assets. Why? Because the United States national debt just crossed $38.5 trillion. Interest payments on that debt are consuming an ever larger portion of the federal budget. The Federal Reserve is trapped in what economists call fiscal dominance. They cannot raise rates high enough to kill inflation or cool precious metals without triggering a sovereign debt crisis. Paul Volcker broke the 1980 gold rally by raising rates to 20%. Jerome Powell cannot do that today without collapsing the Treasury market. This is not 1980. The playbook has changed. And the bears are using outdated assumptions. The second driver is the structural silver deficit. In 2025, the physical silver market recorded a deficit of over 200 million ounces. That means industrial and investment demand exceeded mining supply by 200 million ounces. This is not a one-year anomaly. The Silver Institute projects that cumulative shortfalls could exceed 1.5 billion ounces by 2030. New mining projects take a decade to reach full capacity. You cannot flip a switch and create silver. You have to dig it out of the ground, and the ground is not cooperating. Meanwhile, the AI squeeze is accelerating demand. Silver is critical for data center hardware, for artificial intelligence infrastructure, for the semiconductors that power machine learning. First Solar and other major manufacturers are facing surging input costs because they cannot secure enough physical metal. The solar industry alone consumed over 200 million ounces in 2025. Electric vehicles require significantly more silver than traditional cars. Every power electronics module, every charging infrastructure component, every battery management system needs silver. The green energy transition is not optional. It is mandated by governments worldwide. And there is no substitute for silver in these applications. Now let me address the volatility argument directly. The analyst said that markets this volatile typically favor the downside. This is statistically accurate in normal markets. But we are not in a normal market. We are in a market where the underlying asset is in structural deficit, where the currency it is priced in is being debased by 38 trillion in debt, and where central banks are the largest buyers. When the fundamentals are this strong, volatility is not a sell signal. It is a buying opportunity manufactured by exchanges and institutions to shake out weak hands. The CME raised margins twice in 60 days. Each time, leveraged traders were forced to liquidate. Each time, the price crashed temporarily, and each time, the market recovered to new highs within days. This pattern is not bearish. It is the signature of a bull market being artificially suppressed by paper market mechanics while physical demand overwhelms supply. Let me show you what the smart money actually did in 2025. Newmont Corporation, the world's largest gold producer, saw its stock surge approximately 170%. Barrick Gold Corporation gained 182% and initiated a multi-billion-dollar share buyback program. Pan American Silver and Wheaton Precious Metals emerged as top performers in the silver sector. These are not speculative penny stocks. These are the largest, most sophisticated mining operations on the planet. And they are trading at all-time highs because their executives understand that the bull market is structural, not speculative. The mining titans finished the year with coffers full of cash. Analysts are projecting a wave of mergers and acquisitions in 2026 as these companies acquire smaller explorers to replenish their reserves. This is not the behavior of an industry expecting prices to collapse. This is the behavior of an industry positioning for prices to go much higher. The analyst warned that if silver goes parabolic from here again, it would be a bad sign that could wreck other markets through contagion. Let me translate what he is actually saying. He is saying that if silver continues to rise, it will expose the fragility of the paper financial system. Now, let me give you my outlook for 2026. The short term will continue to be volatile. The CME will continue to raise margins whenever prices move too fast. There will be flash crashes and scary headlines. The financial media will continue to call it a bubble. They will continue to warn about tears. This is predictable because it has happened at every stage of this bull market. But the long-term trajectory is set in stone by mathematics. The deficit is structural. The demand is growing. The supply is constrained. The currency is being debased. Central banks are buying. There's no scenario where these forces reverse simultaneously. The only variable is time. Whether silver hits $100 in 3 months or 12 months is unknowable, but the direction is inevitable. The analyst made one prediction that I actually agree with. He said that silver will end up forming a higher floor than it did a few years ago. He does not expect silver to drop back to $20 or even $18. This is important. Even the bears acknowledge that the old price levels are gone forever. The question is not whether to own silver. The question is at what level you accumulate. The bears say, wait for a crash. But the crashes are manufactured by margin hikes during thin liquidity. And they get bought immediately by institutional and industrial buyers who understand the supply picture. If you wait for the perfect entry, you may be waiting forever while the price marches higher. Here's my advice for navigating this market in 2026. First, size your positions according to the volatility. The analyst was correct that you should not be over-leveraged in a market with 10% daily swings. Use position sizing that allows you to hold through the crashes without getting stopped out. Second, focus on physical metal and mining stocks rather than leveraged futures. The CME has proven repeatedly that they will change the rules whenever leveraged longs threaten the short positions of the major banks. If you cannot beat their game, do not play their game. Third, use the crashes as accumulation opportunities. Every margin hike, every flash crash, every scary headline is a chance to add to your position at lower prices. The weak hands sell. The strong hands buy. Be a strong hand. Fourth, remember why you are in this trade. You are not trying to make a quick profit and get out. You are positioning for a generational wealth transfer as the world reprices hard assets against debasing currencies. This is a multi-year thesis, not a day trade. Let me leave you with some perspective from history. In 1979, gold and silver exploded higher for reasons that included the Iranian Revolution and the Hunt brothers' attempt to corner the silver market. That rally ended when Paul Volcker raised rates to 20%. But today's rally is different. It is not driven by geopolitical shocks or market manipulation. It is driven by central bank policy, sovereign debt concerns, and structural industrial demand. The Federal Reserve cannot raise rates to 20% without collapsing the Treasury market. They cannot stop the mining deficits. They cannot make central banks stop buying gold. They cannot eliminate the silver required for solar panels and AI data centers. The forces driving this bull market are not cyclical. They are secular. And secular trends do not end in tears. They end in new monetary regimes. So yes, the volatility will continue. Yes, there will be more crashes. Yes, the financial media will try to scare you out of your position. But when you zoom out and look at the big picture, the case for silver has never been clearer. We just finished the best year since 1979. The structural deficit is accelerating. The central banks are buying. The Fed is cutting rates. The dollar is weakening. And the same people who were wrong about silver at 30 are now warning you about silver at 70. Consider the source, consider the motive, and consider where you want to be when silver crosses $100. Happy New Year, everyone. 2026 is going to be extraordinary. Stay positioned, stay patient, and I will see you in the next update.